And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. With all the turmoil in the markets, there is increasing interest in ETFs that provide downside protection. One strategy, known as buffers, use options to provide that downside protection. Let's talk with Brian Lake. He's the Chief Transformation Officer at Goldman Sachs. Also joining us, Mike Akins from ETF Action. Brian, Goldman, you just came out with a new buffer one last week. You have 3 of them. Let's not assume everybody knows what these products are. Explain to us how these buffer products work. What kind of protection are you getting? What are you giving up when you?
Let's start as an investor. I'm an investor, you're an investor, the folks watching are investors, and there's an incredible amount of uncertainty right now. Tariffs, the widening out of equity markets away from Mag 7, geopolitical issues. There's a lot of uncertainty. The buffer products are designed to help protect people to the downside while also allowing them to participate to the upside. Now, what we've done with this suite of products is the way they're designed is they'll protect from down 5% to 15% while still allowing you to participate upwards of 5 to 7%. And then those reset on a quarterly basis.
So you are protection from 5 to 15%. There's another protection 30% below that. It's sort of 2 levels of protection in this product. Then you participate in the upside up to 5 to 7. So you're giving up, if you do more than 7% upside, you're giving up that.
Yeah, the challenging market, which is the question I always like to ask, is what's a challenging market for these strategies? Straight up, right? A straight up market would be a challenging because you would be capped to the upside. But again, that's the cost of getting the protection to the downside, which so many investors are looking for in this market environment.
Right, so there's 3 of these that you had. That you just had a new one, and they reset every 3 months, right?
Yeah, but that's an intentional design thing. So it's a suite of 3. Each of them set every quarter, but the way that we've staggered the launches is at any month, at the beginning of the month, you've got one of our buffer strategies that's resetting and ready for you to invest in.
So this reset date is very important. Again, let's not assume anybody understands this. It's important, we've said this before, to own these near the reset date and then hold them through the entire period. Why is that important? Explain to the viewers what happens with these.
So the market's going to move intra-month, but as we strike the options that are going into these strategies, they're the most precise for the outcomes that we're trying to design at the beginning of the month, because that's where we've priced it. Now, as soon as we go to day 2, the market's moved a little bit, and those hedges that we're providing, either that downside protection or the cap on the upside, is going to have moved a little bit. But if you enter at the beginning of the month, you should have it pretty set the way that they're designed. You can also go on the website and see exactly where we sit on any given day so that you can understand exactly what your outcome should look like over the next quarter.
Mike, you're sort of the grand ETF poobah around here. I have you here to sort of explain these a little bit more. Give us your general thoughts on these buffer ETFs. Are these valuable products? Talk us a little bit about how you feel about them.
Yeah, so I think first and foremost, I do think they're valuable products, but like all ETFs out there in the market that are going away from your true traditional beta, it's in the way that you use it and how you apply it to your portfolio. So, I always think of the Eric Clapton song that was in The Color of Money. It's in the way that you use it, in the sense that if you're properly understanding how the product reacts to your portfolio, and you know that, hey, is this a replacement to equity? Is this a complement to fixed income? Putting that in there and understanding your results, they provide a very unique way to get access to the market and really buffer away some of that downside that you might see in an ordinary course market like we're seeing recently. But there's key elements to this that really need to understand. I think Brian did a great job talking about it. But 1, how much protection are you receiving? 2, what are the reset months? Because owning it for the entire period of your reset is key because of that time element of pricing options. Recently, as we know, we've had a ton of market volatility, and markets have been down. Some cases that Qs was down 4% a couple days ago. A buffered ETF doesn't mean that you're not going to lose some of that 4% on the day it goes down %, even though it's in that protection period, because you have to hold it for the whole time period to get that full protection because of the pricing element of those options. That's really important to understand. So if you were to just turn around and sell it, you're not going to get that 2% or whatever protection that you lost on that one day of element. So that's really important to understand. And I think that's why you're seeing strategies like Goldman's becoming more popular, because instead of having to hold it for an entire reset period and having one strike price for that whole period, they're resetting on every month for a portion of the portfolio, giving you more of a smooth ride. You also see that in the laddered strategies, which are getting a lot of the flows. So from a viewer's perspective, if you're just looking to protect and you don't want to have to manage that, where you're at with that buffer cap, both on the downside, look at the laddered strategies and the strategies that reset more often.
So just to review here, what you're doing with these buffer ETFs, you're trading some of the upside potential for downside, for reduced downside risk, essentially, right? So you allow to participate up to some level of the market gains, 5 to 7% on the S&P, you said, and then you use options to protect on the downside, essentially. And this resets at the end of every period here. In this case, every 3 months, right? Each one, there's 3 of them, right? So here's your basic summary of what's going on with these. So tell us about the risks and the considerations of investing in these products. I mean, obviously there's this market timing thing you were talking about. Tell us about the expense ratio. There's costs involved here, and your pricing options. Just give the viewer a sense of what's the risk here.
Yeah, I mean, these are importantly tried and true strategies that have been used by investors for decades now. And
the Goldman Sachs, sophisticated Goldman Sachs, the Goldman Sachs trading desk has been doing this strategy for decades, right? There's nothing radically new here. It's just in an ETF wrapper.
The innovation is that we're delivering it now through this ETF wrapper, which is so convenient for all types of investors to get access to. So there's definitely history around these. Now, we talked about one of the major risks, that if the markets go straight up, you could be foregoing some of the upside that you would be getting if you didn't have this option strategy. But that's kind of the cost of getting that downside protection, which again, if you think about where the markets are, historically, hitting all-time highs not too recently ago, or just recently, I should say, that's good. The expense ratio here, 50 basis points. So, we're really delivering these really sophisticated strategies, the ETF wrapper that's super convenient for investors to use at a pretty attractive price point.
So, what's interesting is that, and here we're listing some of these risks and consideration, the timing, the expense rate, 50 basis points, 0.5%. This is a sort of subsector of the ETF space. I don't know what you call it, alternative ETFs. Mike calls it that. With just a lot of innovation in the last couple of years here. Some people want more yield. You became quite famous with JEPI, the JP Morgan product that basically sells call options and collects yield. Some people want yield, like the JEPI product, and you have a Goldman Sachs product. Some are worried about the highs and getting protection, which is what we're talking about today. But the point is that this kind of I don't know what you call alt ETF space is really kind of grown in the last few years.
Yeah, I want to be careful with the wording here, because I think alt means a lot of things to a lot of people.
Give me more specific.
But I do think about, I think buffer is a really healthy way to talk about it, is it can buffer your returns, and we're using options in order to do that. Some of the strategies that we offer, like the premium incomes, GPIQ and GPIX, that we offer, use options to give you more income. And so these are strategies where we're using options that, again, are have been available for decades, embedding them into ETF strategies, and then making them available at really attractive fee levels for investors to build better portfolios. And I think that's what this is often about, right? What you now have are thousands of ETFs so that every investor can build their perfect portfolio. What they're trying to accomplish there are more tools than ever for them to pull them in and try to drive the outcome that they're seeking, not just some generic outcome.
Mike, it's a little dizzying sorting these alternative ETFs is the word I'm using out, but give us your thoughts on this. We just put up a board here showing some of these strategies. So there's buffer strategies that use options to provide downside protection. That's what we're doing right here. There's synthetic income. They use options to generate income. There are leverage and inverse products. They use derivatives to magnify the return, so you get 1 or 2 times or 3 times the leverage and inverse. We have single stock ETFs that amplify positions, like NVIDIA 2 times or 2 times inverse. And then we have option overlay products, call options. Sort this out for us. Explain where these products have a particular use case, or where is the growth area?
Yeah, so one, just clarification, we do refer to these as non-traditional. Alternative we save for things like managed futures, true alt strategies. We do call these non-traditional. So if you were to go to our website and look at look at one of our dashboards. This would be under our non-traditional dashboard.
Okay.
But the growth has been incredible, right? You've gone in just the buffer space from basically no ETFs 5 years ago to over 60 billion today, seen the same type of trajectory, though they've been around longer, the same time of growth trajectory in synthetic income. The leverage inverse is continuing to grow, though, big caveat between leverage inverse and what you're seeing like with buffers and synthetic income. We see buffers and synthetic incomes being used by institutions to a large degree. When you look at the ownership data that's available publicly, you don't see any of that with these single stock leveraged inverse ETFs, and very little with just leveraged inverse strategies. So a little different.
You mean it's all
buyer's
retail?
Market.
Is that what you're saying, Mike? It's all retail? You mean leverage and inverse?
Retail, yeah. Leverage and inverse, so like 95% of leveraged inverse strategies you can't tie back to 13F filings.
Yeah, and I think of those as more trading vehicles. And so yes, they're in the ETF, but the strategies that we're talking about here, that they're part of a broader portfolio where you're thoughtful about what you want to deliver over time. The leveraged and inverse is really designed to be a traded vehicle, and you can get in and out of those, on that. But of course, you need to be very aware. So in my mind, and I think for investors' minds, they need to really separate those things very differently. A buffer strategy is going to lower the volatility in your portfolio. A premium income strategy is going to lower the volatility in your portfolio, whereas some of the leveraged and inverse things are going to move in very different patterns than the other things.
Well, that's a very good point. I mean, people don't ask this question enough, which is if I buy these products, which includes everything, includes Bitcoin too, what does it do for my portfolio? Well, I own stocks, I own bonds, I own cash, money market, I might own some real estate. Okay, why should I add a option overlay strategy? Why should I add Bitcoin? And in a traditional question, that's the question asked. Does it improve the return?
Right.
Does it reduce volatility? Mm-hmm. There's certain standard questions, and yet a lot of people don't ask it. They just say, "Oh, I think Bitcoin will get me rich quick. Let's buy more Bitcoin."
Yeah, Bob, and you and I have talked about a lot, which is we love this industry because at the heart of our industry, it's helping people achieve their financial goals. Whether that's retire with dignity, whether that's pay for healthcare, whether that's vacation, education, there's a lot of good objectives that people have. And so we're developing these tools to help people achieve those objectives. Now, these strategies go into a portfolio construction methodology that allows you then to help drive different outcomes for that. The other reason you and I love the ETF industry is it's 100% transparent. You can go onto our website at any point in time and you can see exactly what we own within these, and we encourage people to do that because it's a great benefit of the ETFs. You know what you own, and with these strategies, it's the same. You can go on there, you can look at the holdings, and there's also pieces there to educate and to help understand what these are intended to do, which again then helps educate people, and they get better outcomes for their investments.
I think the key point you're making here, you made a very good point about the volatility. What is it adding to your portfolio? And leverage and inverse increases volatility, whereas buffers, synthetic income lowers volatility.
Yeah.
That's a very important consideration when you're putting together a product. I've always said I've had problems with leverage and inverse for years for exactly that reason. Yeah. People can't wrap their head around the daily reset. Tremendously volatile.
When we talk to clients about the buffered strategies and synthetic income, the key data point we tell them to dial into is up-down capture, right? So what percentage up-down capture? And buffer is a great example because these buffer ETFs, they all have different amounts of losses that they're looking to buffer away. And the ones with lesser amounts of losses tend to have higher up-down capture ratios relative to their broad market. Ones with more, that provide more protection, are going to have lower up-down capture ratios. And that's just a sense of your beta, your volatility to your underlying index, what you're willing to give up in terms of upside capture to protect on the downside. And that stands true for the synthetic income products as well. And it's a key element to look at. If you're capturing a neutral, or better yet, a positive up-down capture to the market that you're tracking, they definitely have good benefits to your portfolio if used correctly and understanding what it means to your overall risk return perspective.
I want to just go ahead. Do you want to say something?
I was going to agree with Mike there, and what he just said goes into the design process for how we build products. So we talk to investors and we say, what are you actually trying to achieve? And if you were to use a buffer in your portfolio, what would be those thresholds that you would find attractive to building better portfolios? Which is why we've intentionally picked this 5 to 15% range with the 5 to 7% on the upside. That was an intentional choice that we made based on how we talk to investors and research and experience that we have at Goldman.
Yeah, I want to talk a little bit about synthetic income products. You became quite famous over at JP Morgan for helping create JEPI. Goldman has products here that provide premium income, essentially. You have an S&P product, GPIX, and a NASDAQ 100, GPIQ. So what does this mean, synthetic income? You're using options to generate income. Explain how this works with the S&P product. This is GPIX, is the symbol.
It's pretty straightforward. You're using covered calls on equities or on indexes that you own within the portfolio, and what that allows you to do. So
you're taking, now all of a sudden you have money, you have premium, you have something there that you give back to the investor, but there is a cap on the upside because you're selling a call, right?
Right, yeah. So you sell that call, you get the premium in for that, and then you can pay that out as income. And as we look at this space, that's one category that's been evergreen for investors. A lot of investors are looking for income on a consistent basis.
Right, so here it is. What is this paying out right now? By the way, this is not protecting you from, you can see here, this has been down the last few days like everything else, but you're collecting money here. What kind of premium are you paying out here right now? If I would own this right now?
Yeah, I don't know the yield off the top of my head, to be completely transparent with you, Bob. What you tend to think about is the VIX. The higher the VIX is, the more your income is going to go up with that. And so with the increased volatility that we've seen, the income should
you collect more money for selling the
be
call?
Increasing with that. Yeah,
right, okay. We were talking yesterday. You had a great career at JP Morgan. You moved a while ago to a big position at Goldman Sachs. And you told me yesterday that you've learned a tremendous amount since going from JP Morgan to Goldman. These are the two big firms on Wall Street. This is a big move to make from two big firms. What have you learned in the last 6-8 months? Tell me how you seem to imply your thinking has changed a bit, grown, expanded. I don't know.
Yeah, well, I mean, it goes back to the core of what we talked about earlier, is good outcomes for investors. And we're seeing innovation happen in so many different places in this industry that it's really just a great opportunity to do that. And at Goldman, where we're a top 5 provider in active equity or in active public securities, we're a top 5 in alternative capabilities. And we think increasingly combining public and private in portfolios is going to be a really big trend. So the fact that we have public and private capabilities to deliver, I think, is really important. We also think that increasingly solutions and customized solutions are going to play an important part in investors' portfolios. So whether that's direct indexing, SMAs, models, that's another area where we're leading and continuing to develop technology that helps do that for investors' portfolios. And then the last thing that we've been talking about here is active ETFs. There's no doubt in my mind that active ETFs are going to continue to grow at a very rapid pace, but as we step back and think about the entire investor's portfolio, there's a lot of things that are now becoming available to them to help build those portfolios. Retail alts, separately managed accounts, direct indexing, and active ETFs all coming together to help drive better outcomes.
The beauty is the wrapper itself. The ETF wrapper is what has enabled all of this.
ETF has enabled a lot of this. I would argue that technology has enabled a lot of this. I mean, here we are on the floor of the exchange. The change from fractions to decimalization unlocked a lot of this. And you could argue that ETFs were the first fintech, but as technology came along, that's allowed us to do direct indexing at much more lower levels, which helps drive better tax outcomes for some investors because you can offset some gains in those strategies. It allows you to build model portfolios where you're combining different asset classes, different ETFs to help drive that. Or as we were talking about earlier, alternative assets, private credit, private equity, infrastructure, real estate. All of these things contribute to portfolios. Private equity can help drive returns. Private credit can increase your yield. Real estate and infrastructure can be diversifiers in your portfolios. And so you're now seeing all this innovation come along with those. And as you incorporate that into the total portfolio for investors, you're really starting to see some pretty cool innovation that's happening. And I think that those are things that are going to continue to grow.
Well said. We just have to keep on top of being able to explain it to the viewers.
Couldn't agree more.
Thank you for helping us explain all that. Michael, thank you as well. Interesting discussion, folks. Yep. And again, we're on top of all the innovations going on in the ETF world. And that does it, though, for this week's ETF Edge. My thanks to Brian and to Mike. We've asked Mike to stick around and provide more insight into current ETF trends. That's on the ETF Edge podcast coming up. And remember, you can see all of our shows on our website. It's our 7th year, folks, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.